Hi, everyone. Thanks for joining. My name's Eric Chan, and I'm with Chargebee. Today, we're here to talk about simplifying revenue recognition for your subscription business. As I mentioned, I'm Eric. I'm responsible for partnerships at Chargebee, and I'm joined here with Michael, Akshay, and Rakesh. Michael, please introduce yourself.
Hey, thanks, Eric. Looking forward to today. So Michael Krantz from GoCardless. I oversee some of our top partnerships. GoCardless is a recurring payment method that focuses on direct debits and open banking. Looking forward to today's session.
Akshay?
Thanks for having me, Eric. Yeah, my name is Akshay Shrimanker. I'm the CEO and founder of ShayCPA. We're a New York City-based certified public accounting firm that help early stage technology companies with financial reporting and tax compliance. And what makes this topic relevant to us is that we help many companies with software that are software as a service with financial reporting. And what we often see is that they struggle with accurately reporting their revenue or are using spreadsheets. So yeah, excited to get into this topic.
Great. And Rakesh?
Thanks, Eric. Yeah, likewise with everyone else, very excited to be here. Thrive Growth Partners is a outsourced CFO business. We primarily work with early stage to Series A type technology companies, mostly in the SaaS space. So this is an area which comes up quite a bit with all of our clients, which is trying to figure out how to book revenues correctly, automate those processes, and ultimately let those clients scale up very quickly without worrying too much about the back office finance function. So very excited to get going, really.
Great. So let's get started. But first, start off here with what is revenue recognition? I believe Akshay, you were gonna.
Yeah. So yeah, I'll kick this off. So yeah, what is revenue recognition? Essentially, the early stage companies we work with, right? They are usually come on board as cash-based basis companies, meaning that they record revenue when the cash actually comes in, versus what revenue recognition is really all about is recording revenue as it's actually earned and recording it whether it's a performance-based period or as time goes on, you need to be recording revenue. So essentially here, with accountants, we love rules, and the rules that sort of overarch this are twofold. One is ASC 606, and another is IFRS 15, which is sort of the worldwide standard. ASC 606 is the GAAP-based rules that apply to US-based companies. So what brought on, just a little bit of history, what brought on ASC 606 was previously there was a standard ASC 605. And essentially what this standard was focused on was collectability and making sure that the company can actually collect revenue before it can record it. So what ended up happening here was companies would record revenue more on the cash basis. And with ASC 606 now, it's sort of flipped in that we now need to be booking revenue as it's actually earned. So there's a twofold reason for this. One was companies across industries were booking their revenues in different ways. And then secondly, to get the international standards more in line with get US GAAP more in line with international standards, there was a convergence. So ASC 606 and IFRS 15 are sort of the two overarching standards that sort of are on top of these rules. And I guess on the next slide, we can just talk a little bit about the actual adoption date. So why is this revenue recognition standard important to you? So this applies to both public and private entities, for-profit entities, not-for-profit entities. So many of the companies that we work with, which are venture-backed, they still need to do financial reporting and GAAP-based financials, whether they're having a financial statement audit or having to just report their financials to their investors. So ASC 606 really applies to them. So public companies have already adopted ASC 606. Private entities had until December 15th, 2020. Past that date, any financial statement periods, so beginning calendar year 2021 or any fiscal years that fall in 2021, this standard really applies to you at this point. IFRS 15, that standard had already started to apply to companies back in 2018. So the companies in Europe and worldwide are slightly ahead of the US entities here, although many US companies have sort of early adopted ASC 606 and have already started to make some implementation plans. So I guess we can just go to the next slide where we talk about a quick case study, just so that we have a visual representation of what this looks like. So here we have a company, Tagore Inc., a SaaS-based business. So they sign a new customer and the customer pays them $12,000 for an annual contract. Under the cash basis of accounting, you would book this all in the month that the money was received and when you invoiced it, whilst on the accrual basis, regardless of when they actually pay, you would book this month by month as the revenue is actually earned, right? So as you perform each your obligation under that contract every month, you would record that revenue over the course of the year. So this is a bit of a sea change in the way of thinking, because most companies, for instance, we work with companies that use QuickBooks. When they do their invoicing, the invoice goes out and the invoice is directly tied to their P&L, and the revenue is booked when the invoice is actually sent out. So switching to this accrual basis, it would require making some adjusting journal entries. It would require keeping track of this type of stuff on spreadsheets, and that's where tools like Chargebee can come in to help automate some of that reporting. So let's just talk about the 5 steps of revenue recognition. So ASC 606 is sort of principle-based. So these are the principles that need to be followed when thinking about booking revenue. So the first one being identifying the contract with a customer. So for most SaaS-based businesses, this isn't too difficult to do because everything is sort of online and there's an actual contract. However, there could be contracts that aren't written, or there could be contracts that have like indefinite dates, which we may touch on a little later. So that's something to consider there. Identify the performance obligations in the contracts, the second one. So this one comes up very frequently for us. Beyond the actual subscription that you may have with your customer. So for instance, the 12K example that we gave earlier, you may also have setup fees upfront or other custom work that's done. And those sort of obligations that you may have in the contract need to be separately sort of identified. So the third thing, determining the transaction price and allocating the transaction price to the fourth step, those two need to be tied back to those actual performance obligations. So depending on what is the cost of the subscription, the price needs to be allocated to that versus what was the price of the setup or the custom work that was done. And depending on how those allocations are done, that fifth step of recognizing that revenue when or as the entity satisfies a performance obligation becomes critical, because essentially you wouldn't be just recording the revenue all up front. Some of that setup work or the custom work that you do may need to be booked at different points in that actual customer's life cycle of that contract. So these are sort of the main principles. It does get a little bit deeper than this, but I think this would be a good sort of like entry point just to understand some of the issues to consider when you are recording revenue with your clients. So with that, I think I'll just pass it over to Rakesh so he can go over an example.
So thank you, Akshay. That was really, really helpful to get a broad overview of what revenue recognition actually is. I am going to talk through from a sort of CFO perspective why this is important and illustrate this with a case study for a digital fitness business that we recently implemented Chargebee and GoCardless for. And this is quite a typical SaaS business. They didn't actually know how much their annual recurring revenue was when we came on board. They thought it was about $1 million, but they weren't really totally sure. They were thinking it might be $1.5 million. It was a very typical story in the sense that it was a company that scaled pretty quickly. It went from 0 to 500 clients within a 3-year period. And as time had gone on, things had got more complicated, as often is the case with all SaaS businesses when we initially start off with just one plan for one time frame, which probably would be monthly or annually. And as time goes on, you'll expand. So this particular company, they eventually had monthly, quarterly, semi-annually, or 6-monthly, and annual packages. Some of these packages had discounts attached to them, some didn't. They had different tiers of packages, so you could have more of a premium service, or you could have a more basic service, and you could upgrade and downgrade amongst these different tiers almost every month. So and sometimes and in some cases midway through the month. So it became quite difficult for them to figure out what their revenues were on a month-by-month basis when these things were changing. They had kind of got to the point where they had just about perfected the monthly side and the annual side. The quarterly side was still causing them a few issues because that tended to be, there used to be complications around that where people were on a quarterly and then they shifted to a monthly, or they were on a semi-annual and they shifted to a monthly, and that caused them all sorts of problems when it came to revenue recognition and just generally recording how that would work. But other than that, they were up and coming SaaS business and things were going generally quite well for them. Just their back office had been somewhat neglected. Another area that they were thinking about was they wanted to raise money. They didn't have proper financials in terms of a P&L or any proper financial metrics around monthly reoccurring or average revenue per customer or any of the typical metrics that you might expect any typical SaaS-based investor really to be looking at. So we were brought on board to essentially recommend a solution to this problem, which we looked at the market to first learn about what was out there, and that was how we discovered Chargebee. And we assessed Chargebee against a number of different competitors, and ultimately, as you can imagine, we chose Chargebee. So we'll move on to the next slide now, and we'll just go over sort of issues they were having in a bit more detail. So they were having problems with revenue recognition. They were not able to correctly know how much revenue to recognize in each month, and they had various packages. All of this was basically done manually, all on spreadsheets. In some cases, not by qualified or highly trained accountants, but in some cases admin people who may not understand it. We definitely wouldn't understand about revenue recognition. So it looked about right, but was in some cases quite wrong. And because of all of these issues, they were unable to determine what their monthly recurring revenue was. If they were ever able to manage to do it, it would take them approximately 3 weeks to get to the point where they were able to give a report to the CEO. And frankly, the CEO knew that the report was wrong, but they were unable to find a way to resolve those issues. There was a few admin people doing a lot of duplicated work where they would, for example, enter something into GoCardless to actually take the payment from the customer, and at the same time they would enter something into their finance system, Xero, in their case Xero, when in fact they didn't need to do 2 things at the same time. They could have just done it all within one thing, and it would have done the relevant entries across all the different systems. So there was a lot of those sorts of issues. So once we implemented Chargebee, it thankfully integrated with all of the back-end payment gateways that they used. They happened to use 3, GoCardless being one of their primary one, but they did use a few others. And the great thing was that they were able to essentially have a customer come to their website, order the service that they wanted. That immediately kicked off a GoCardless transaction. in the background that was completely automated from the company's point of view. It allowed that customer to have a online portal that they could access whenever they felt like. If they wanted to upgrade or downgrade, they could do it via the online portal. All of this was managed via Chargebee, so they didn't have to set up a customer portal of their own. It was just a standard product, part of the product that comes with Chargebee. And that automated a lot of their processes. And then because all of their billing was now being automated via Chargebee, all of their payments were being automated via the likes of GoCardless, and these two things were being reconciled automatically, that removed 80% of the work for these admin people. And finally, then we were able to start looking at revenue recognition. And there's a very convenient report where we're able to just go into Chargebee, press a few buttons, and it will spit out the relevant report for deferred revenue. And we were able to see our monthly revenue really easily. And that report can also be done in a sort of dashboard format, again, which is easily available in Chargebee. And that allowed the CEO to just have a login to Chargebee, look at his dashboard on the part of the system is called Revenue Story. They were able to look at their dashboard on this thing called Revenue Story, and it gave them all of the sort of metrics around the different packages that they were offering, which ones were doing better than others, how much he was making month on month, and all of those sorts of bits of detail that any CEO of a up-and-coming SaaS business may want to know. So it was just overall, it was just a bit of a game changer for them. And the best thing was it also integrated with Xero. So I mentioned there was duplicate work where things were being entered into, say, GoCardless, and they were having to be entered into Xero. In this case, what happened was Chargebee became the central billing system. It initiated any payment requests via GoCardless. When the payment request came in, it would record that. When the money came in, it would record the money coming in. It would then make sure that the invoice was then marked as paid, and at the same time, it replicated all of these entries in Xero. So everything was fully integrated. So you could bring up an invoice in Xero, click on a button, and it would take you to Chargebee, and it would actually show you the invoice, and it would show you that it's been paid. So there was no significant problems on Xero, GoCardless, or Chargebee. So ultimately, it automated the entire process and gave us all the sort of stats that we needed. After that, they were just super happy with the overall implementation, the overall analysis they were able to get with the system, and frankly, they were able to retask the admin people to more customer-facing roles, which helped their business and provide better customer service rather than having these admin people focused on doing back office work, which didn't really need to be done anymore. So I will leave it there for now, and move on to the next part. Over to you, Michael.
Thanks, Rakesh.
All right, perfect. So yeah, in a perfect world, once you sorted through your revenue recognition with something like Chargebee, you receive and track your payments in alignment with that revenue recognition, and everything's easy. But that's generally not the case. We don't live in a perfect world. I think we found that out over the past year. So one thing I did just want to highlight was, for businesses, payments are no longer a back office function, and just wanted to talk through a few things here where those worlds, back office and front office, often collide and have business impact. So there's three main ways to look at your payments. First, you have your customer acquisition. This includes things like your payment coverage, where you can accept payments, the preference that your end customers choose to pay, the chance that they'll move forward with something and convert once presented with a payment option. And you would think of this as customer acquisition, but these are not siloed from the back office. If you think of growing internationally, you expand your coverage. Now you're dealing with new markets, more business, more customers, but you have now multiple currencies that are coming into effect here. Then as you move over to the operational aspect of your business, I'll touch on cost in a moment, but not every payment is successful. So even if you're recognizing revenue, back to the $12,000 example, $1,000 a month, you hope that you get that $1,000 every month, but that's not always the case. So you want to make sure that you maximize your payment success and reduce the burden on collecting and recovering those payments should they fail. From a visibility perspective, Rakesh outlined a great use case there of how having an integrated solutions like a Chargebee and a GoCardless and a QuickBooks, and seeing what happens throughout the entire payment lifecycle, that reporting capabilities, how it also reduces the burden of admin and back office. Again, I'll come to cost in a moment. And then what's the outcome? When you're dealing with payments, there's two key things you should think about. The first is cash flow. So you want to make sure that you choose a payment method that gets you paid on time, so that when you're recognizing revenue, hopefully that money is also in the bank. And from a churn perspective, if you have failed payments, 11 to 15% of failed payments result in involuntary churn. So you may have recognized revenue or have a plan to for 12 months. If there's a failed payment in that third month and that customer churns, you're going to have to relook at what you're forecasting with regards to that revenue recognition piece. Next slide, piece, just to talk on costs for one moment. So most people, when they think about payment costs, they think of this big pink transaction fee. When in reality, that's more so like the top of the iceberg. When you look below the water, you can see how these operational costs really can compound on one another. Obviously, when you're doing payment reconciliation, if it's very manual with the spreadsheets and all the time that you're spending on reconciling things, these costs add up. The labor is much more expensive than a simple transaction fee. As well as just collecting your payments, and you can see all the different points highlighted here. 2/3 of payment costs are actually manual efforts and admin. And I think a story that we can all probably resonate with is, let's say it's a Friday afternoon, you finish a long week of work, you go to the grocery store, there's a long line, you get up there and typically, you pay with your card and you're on your way. But we've all been there where there's a nice old lady and she pulls out her checkbook and she has to write down the dollar amounts, and then they hand it over to the cashier. They put it through this machine that has to run it. It's all very, manual, and it can lead to inaccuracies. And if you look at that from the perspective of your business, when you're dealing with invoicing and having push payments, and how long does it take to send a check or a wire transfer, all these non-automated or offline payment types can really compound and grow the costs of operating your business. So not just from a revenue reconciliation perspective, but when that money is due, what are the impacts that it has on your business? And just wanted to highlight those things. So that's all for me, I think, right now. Eric?
Great, thanks, Michael. Well, that's the end of the sort of presentations. I guess we'll now open it up to some questions from the audience. I guess while we're waiting for some of the questions to come in, I have a few questions that I wanted to ask the panelists here. So the first one is my revenue recognition complex that a spreadsheet is not enough? So I'm sure there's a couple of people in the audience that are probably doing the revenue recognition with a nicely structured spreadsheet. Did Akshay or Rakesh wanted to take that question?
Yeah, I see a lot of businesses do it by spreadsheet. And if you're only doing revenue recognition on a spreadsheet, I'm not saying it's completely wrong to do. If you're a small business, you've got 10 customers, and you sell the same package or same price every month, maybe that's perfectly fine. There's no harm in that. The main issue comes for me is when you see businesses adding more complexity to their pricing, having many different tiers of pricing, different packages, and different terms, different different types of packages, from annual, monthly, semi-annually, all these different things. Once you start adding that type of complexity to a system, then a spreadsheet could deal with it and can deal with it. There's lots of companies doing it, but the issue can be that you end up with lots of errors, and often you find the companies I've looked at, when you look back at it and you calculate it again, often you do find there's errors in the spreadsheet that someone's just been using over and over, and that's just what happens, with you. If you've got, it's quite easy to manage 10, 20 clients on a spreadsheet, but once you get to 100, 200, 300 clients, it can become really complicated. And the more complexity that you, if you have a good sales and marketing team, they will be coming up with all sorts of, crazy packages that will be, moving the sort of business forward. And you don't want to be in the way saying, but we can't do that. So that's what I generally find.
Okay, and
Yeah,
I guess oh, go ahead.
Oh, yeah, I was just going to quickly add to Rakesh's point. I think for many startup companies and as tech companies, as they bring on their initial finance folks, right? Their initial VP of finance, or they may hire a controller, their in-house. What ends up happening is there's this sort of the past history, which is sort of a lot of it may be sort of on the cash basis because there just wasn't enough resources to really do the revenue recognition the right way, or they may have had an outsourced accounting team like Rakesh or I helping with that. But so I think it's almost like biting the bullet for a lot of companies, just thinking about when they are ready for this process. It may be an initial setup to do it. It may be a lot of grunt work in the beginning, but I think it's once you get past that initial stage, it should be pretty smooth sailing from that point on once you have those initial processes set up. So that's what I would emphasize is just like thinking about that initial sort of 3 to 6 months or so that you may need to spend on just like getting everything in place. But once you have that, it should be pretty smooth.
Yeah, and just to add to that, Akshay, for my earlier stage clients these days, to be honest with you, I'm still recommending that they go to Chargebee, purely because they do have that free tier. It's not as advanced as the more premium tiers, but if you're a simple business, that free tier can still help you quite a bit, depending on the way you structure your company. So where I can, I'm still trying to push people into using it, just because it makes their life so much easier and gives them information that they wouldn't necessarily have access to otherwise, without generating it manually or paying someone to generate it for them.
So as a follow-on, a slightly more complex question for revenue recognition is how do you handle a contract that doesn't have a termination date from a revenue recognition perspective?
Ooh.
I could maybe try to attack this a little. So I guess it really depends on if it's like a month-to-month contract, or if there was any sort of an annual contract with some sort of a renewal that was at the end of it. Typically what we see, because of revenue recognition, the big thing is collectability, right? So you don't want to book this revenue all up front for like five or some extended period of time when you know that at any point essentially the customer could cancel that contract. So when there isn't a time period that's associated with it, typically for accounting purposes, we would be booking that on a month-by-month basis and not really thinking about the deferred revenue. But if there is a reasonable level expectation that this is going to be an annual contract, then typically under GAAP, you would be recording that over 12 months instead of just on a month-to-month basis. So some of it's a combination of thinking through how is the billing done? Is it on a month-to-month basis, or is it all upfront? And then, most traditional SaaS companies do have some level of agreements, and it kind of goes back to that 5-step process of going through each one of those principles to see which aspects determining the price and the transaction price, and then allocating it to the different performance obligations of the contract. I think that's another thing that needs to be done in there.
Yeah, I think that's a good way to look at it, Akshay. We in the UK, in a slightly unrelated topic, we recently had some accounting standards change on leases, and we had quite a similar issue where in some cases there was no written down lease, and a lot of companies had to do a lot of work to be able to figure out what do you do in terms of what do you book into your accounts, and a lot of the lessons we learned there equally can be applied here to the SaaS world. And in to summarize it, is really you have to use your judgment as best you can, and you got to be kind of okay living in the grey rather than the black and white. And if it is a contract that you've had, say, for 3 years, you build it annually, then you would continue to bill it annually and treat it as an annual contract. If it's a contract that you've only just initiated, but for some reason there is no written down contract, you'd probably ask your lawyers to paper up a contract, just to make sure it's there. And equally, all the ones that you don't have contracts for, you would look to get those papered up as soon as you could, just so that everything looks decent from a due diligence point of view, especially if you're going into a funding round. So it's just always, for me, it's always a case of using your judgment, using the information you have to decide what the best way forward is. There's never quite a easy, clear-cut answer, but most of the time you'll be able to come up with, largely looking at historical evidence, come up with what you should be doing going forward.
Great. I'm going to switch topics a little bit to on the payment side to have Michael jump in here a little bit. So what kind of impact on revenue recognition do integrated solutions have?
Yeah, I mean, so, if you're thinking about when you have multiple disparate systems that are taking in data and you have to go and reconcile that manually, you can just imagine the time that will be needed to be spent on that. And again, just to come back to the example before of the merchant who leveraged GoCardless, Chargebee, QuickBooks, being able to dramatically reduce those times and efforts, and as well as remove any sort of potential mistakes that can occur from manual entry. You're then allowing your finance teams to work on more strategic things, help grow the businesses in different ways. It shouldn't just be, a paper pusher job in the back. If you can automate that and take those efforts and the talents of the people and put them into better places, you're dramatically going to see, growth of the business. And, I think that the one thing that I would point out is, for smaller startups, there may be some hesitancy to spend money up front, and it's a smaller long-term cost when upfront you make the investment and you automate and digitize everything moving forward. So I think there's it's always easy to say we'll get to that in 6 months, but if you do it now, you're dramatically reducing the long-term costs of doing this.
So Michael, we'll go back to this cost thing that you like talking about in a lot of detail. So if you look at some GoCardless customers, what impact on their costs have you seen compared to, let's say, other payment methods?
Yeah, so we actually had a study performed by Forrester just about 6 months ago, where they went out and polled a number of different customers globally in different regions, different market segments, from small business to medium-sized business and enterprise. And they found that by leveraging GoCardless, we reduced the total cost around time and admin by 57%. Also improved the finance team's efficiency by about 21%. And as a bonus, outside of the finance world, customer support efficiency was also improved by 12%. So, it's very much like moving from a spreadsheet to something like a Chargebee. On the payment side, it's analogous. You're automating and digitizing these sorts of activities, and as a byproduct, there's natural cost savings. I should also, yes, love talking about cost, but there's also the other benefits that come with that. When you're dealing with reporting compliance issues, you're mitigating risk in a sense as well. So it can give you some peace of mind when using the appropriate tools.
Great. I guess then one last question for you, Michael. So what are some considerations that you have to think about if you're only looking at the domestic market versus thinking to go outside your own borders and trying to grow your business internationally?
Yeah, I'm in the hot seat 3 in a row here. So if you're currently just doing business domestically, one key thing that you want to look at is the payer preference. How do the end customers want to pay? And you should cater to that preference. Obviously, in the US, we love our credit cards. We love our benefits, but some people like PayPal. You may have an older generation that likes checks. We're seeing a paradigm shift where those offline payments are kind of shrinking, and direct debit, what GoCardless does, is a natural backfill for that. It's essentially a bank-to-bank payment, the same as a check or a wire, but it's all automated and digital. When you're looking to grow internationally, however, you have to understand that not every country is the same, right? There's different payment preferences in different regions, but also there's different payment schemes and rules for the same types of payments. So in the US, we have ACH, which is the direct debit rails that we use here. It's called PAD in Canada or SEPA in the Eurozone. They're all similar, but slightly different. So as you're growing internationally, you want to identify, let's say for bank debit, a provider who has coverage in all of those different schemes. So when you're growing, you're not looking for a second provider because the one you chose didn't have those capabilities.
Great, thanks for that. So I'll turn it over to the audience. Are there any questions? If you could, I guess, post your questions in the chat, we'll be happy to answer them.
I think we did such a thorough job covering everything that no need for questions at this point, but we'll keep it open maybe for another minute.
All right, while we're waiting for some questions, maybe Akshay or Rakesh, did you want to have any sort of final thoughts on this topic?
But just to add on to Michael's point, I certainly, from when I'm advising businesses in terms of payment gateways, I definitely echo what Michael is saying. We tend to look at payment gateway providers who essentially give you global coverage, so that eventually when you are thinking about scaling beyond your own borders, and you start spending money on marketing elsewhere in the world, you're able to onboard these customers through a tried and tested method, and that provider has deep links into those countries to give you that certainty that those payments will happen easily. Because I've had it where where the customer is using a smaller payment gateway, which is great for that local region, but isn't so good once they decide to go a bit bigger. The larger ones tend to have far better integrations with other systems. So it is a real added value being able to get the right payment gateway. And there's lots of good ones out there now. And GoCardless is, I would say, one of the better ones, and they tend to have lower rejection rates. So we tend to use them quite a bit with the companies I work with. But there is lots of good ones. I'm not sure if I can mention them on this call, but lots and lots of good payment gateways out there. and they're getting better and more competitive all the time. So fees are going down constantly.
So Rakesh, I won't put you on the spot. I'll put Eric here. Obviously, there are many different payment gateways beyond GoCardless. We'd love everyone to use us, but you should cater to your payer preference, and that will dictate what you put in there. That's one of the reasons that GoCardless really values the partnership we have with Chargebee, not just on the payment side, but the number of total different integrations that they have is pretty impressive. So Eric, in this example we talked about before, where you're able to integrate QuickBooks and GoCardless and Chargebee, how do you see the partner ecosystem within Chargebee really helping, helping merchants?
We look at it as both a internal and external user experience, right? So Akshay and Rakesh, you had those two use cases, right? One of them is just how do you perform the contract, right? And how do you make sure that you're recording it correctly? So having a good integration with accounting and ERP software to automate a lot of those processes of just simply putting in the transactions and the invoices. The other part of it is what other parts of your organization need access to the subscription data. So if you think about marketing folks or customer success, they need access to the subscription information. They need access to the customer data. It's all contained in our billing system, but they don't necessarily need all the access to the billing system. So that can then be, the data can be pulled into, let's say, a Zendesk for customer support. Maybe it can be exported to something like an ActiveCampaign or MailChimp for some follow-on campaigns based on plan type. In terms of payment, we also make it so that it's as flexible as possible. And sometimes it's hard for a merchant who comes and talks to us to say that they can you support one of the ones that we have? And if it's something that we don't, really trying to accommodate them, because we also do find, and I'm sure Michael sees this too, is once you have GoCardless, it's pretty hard to switch. There has to be a pretty strong and compelling reason. You pick them for a reason, whether it be performance, costs, as well as a bunch of other features that GoCardless has. And so trying to provide as much variety when it comes to that, because at the end of the day, it is how do you make that user experience as frictionless as possible, especially when it comes to something that is on a recurring basis. And any sort of weakness in that sort of value chain causes people to question things, right? Whether it's the right thing I'm purchasing, or is it the right integration? How come the data is not populating correctly, et cetera?
Yeah, I think both Eric and Michael, you both made great points in that it's not just the finance departments that are really touching this info, and they need access to different elements of the data which add value to what they're doing. So I think that's a really super important point. Just one additional thing that I see as well, which sort of impacts the finance area is, founders of tech companies, they're very obsessed with certain metrics. So monthly recurring revenue, annual recurring revenue. Rakesh could probably speak to this a little as well. I think having this deferred revenue recognition sort of down in the company would help making sure that those sort of metrics are more accurate. So that's just one more reason to sort of focus in on this area and just getting it tightened up.
Yeah,
very true.
Absolutely. The amount of times you come across a company that is going into funding round, they haven't thought about their finances too much, can't tell you what their monthly recurring is, and often think that the revenue line in the P&L is the equivalent of a monthly recurring line because they're a subscription business. But then you say, but what about all the one-off costs, which in terms of setting up the client is also in this fee, and trying to then untangle that and come up with the true monthly recurring revenue, which is what the investors are after. You know, being able to just click a few buttons and just have this work is an absolute godsend, you know, to any small business who's trying to grow into, you know, a large SaaS business. Having these tools available, you know, I don't think there's ever been a time where it's been this easy through these tools. You know, there's just, for me, there's an absolute game changer. It makes life so much better. I personally became, you know, I only recently, in the last year and a half, started using Chargebee, and I very quickly just became a massive fan of the product very quickly.
Well, thanks for that, Rakesh. All right. Well, seeing as we're getting close to time, and maybe, like as Michael said, we covered everything, so there aren't many questions. I want to thank everyone for joining today. Thanks, Akshay, Rakesh, and Michael, for also sharing your thoughts. And we'll hopefully see everyone around. Thank you.
Thank you, everyone.
Okay.
Thanks, everyone.
Thanks, everybody. Thank you.